Good afternoon, everyone. Welcome to the Investor Series ESG Investments webinar. Thank you for being here with us today. I am Ace Del Mundo from FTI Consulting Philippines, and I am your host for today's online event. We would like to take this opportunity to recognize our annual corporate sponsors. Platinum sponsor, Sea Oil Philippines Inc. Silver sponsors, BDO Capital, Coco Life Asset Management Company Inc. and FTI Consulting Philippines Inc. Bronze sponsors, AP Securities Incorporated, DPP, Daiwa Capital Markets Philippines Inc. and Papa Securities Corporation. Event partners, FMAP, MART, and Sharefill. And to formally welcome us all today, may we please have the President and Chairman of CFA Society Philippines Inc., Dr. Robert Ramos, CFA, CAIA, and CIPM.
Thank you, Ace, for the warm introduction. In his Harvard Business Review article, Making Sustainability Count, George Seraphim says he believes that ESG issues will continue to be relevant to investors, even in the face of a pandemic and an economic downturn, because companies are more likely to be resilient in the face of unexpected shocks and hardships. They're managed for the long term and in line with megatrends such as inclusion and climate change. Thus, creating and adhering to an ESG framework leads to the future proofing of a business. And those that made this a priority in the years prior to 2020 are also those that have made more tools to deal with the pandemic's varied impacts. Over the past few years, ESG has continued to become an important part of our everyday lives. We now know better to understand its impacts on our world, our society, and our day-to-day lives. This is a topic very close to my heart, and I'm very grateful to our speaker for giving us the time to discuss such an important matter. That being said, I'd like to thank all of you for giving us your precious time to attend this event. Thank you.
Thank you, Rob, for the warm welcome. Again, welcome to the webinar. This is brought to you by CFA Society Philippines. Joining us today to talk about ESG investments is the Director of Capital Markets Policy at the CFA Institute. In his role, he advocates policy positions on issues impacting capital markets, including corporate governance, ESG, and pensions. Siva has 15 years experience in financial services. Previously, he worked at Morningstar, leading its global index product development team and serving as spokesperson for sustainability. Before that, he worked at MSCI, where he co-authored research papers on small-cap investing and portfolio construction. Siva has an MBA from the Indian Institute of Management, Lucknow. He holds the CFA, CIPM, and the Fundamentals of Sustainability Accounting, FSA credential provided by the Sustainability Accounting Standards Board. He is also a visiting faculty at the Indian Institute of Management, Indore, and teaches the course on alternative investments. Without further ado, may we call on Mr. Sivanant Ramachandran, CFA, CIPM.
All right. Thanks, Ace. Thanks, Robert. Thank you, everyone, for thank you, CFA Institute and CFA Society Philippines for the opportunity for me to talk about ESG investments today. And thank you for all the participants who are able to join today. So, ESG is something which is close to CFA Institute and CFA Society Philippines. So we have done a lot of work in the area of ESG, whether it's research, coming up with standards, coming up with certifications on ESG investing, so which I only took recently, so I think it's not part of the introduction which Ace kindly gave. So I'm very excited to talk about this topic today. What I'm going to do is I'm going to make a presentation. So for I think it's about 60 minutes, but I want to intersperse. I'm going to intersperse it with some polling questions throughout, so that you have an opportunity to kind of participate during the session, and it's not just a one-way dialogue, right? What I also would like you to do is if you have any questions or if you have any comments, I would like to hear from you, either through chat or anything else. And, I would like to make it bit interactive so that, it's useful for all of us, right? So with that introduction, let me just share my screen and start the presentation. All right. So in today's session, I'm going to cover these topics. We are going to talk a bit about ESG investing and what are the drivers and influences of ESG investing, right? It's more of setting the stage. We will look at some approaches to ESG investing. So ESG investing is not one thing, right? So there are many ways to kind of look at ESG in select investments according to ESG considerations. So we will look at the approaches to ESG investing. We will look at the ESG investing landscape, which is kind of putting some numbers on around ESG. So a lot of these numbers are based on based on global data, but practically speaking, a lot of the numbers come from developed markets. But we will have a sense of where the investments are going and which approaches are popular in which countries or regions, right? I want to also touch upon the common criticisms around ESG investing. In case you have followed the news around ESG in the last 6 months or a year, some of these criticisms have become you can find them in the news, right? So I want to kind of touch upon some of the common criticisms and what is the potential response, right, to those criticisms. So that's 4. And lastly, looking ahead, how does ESG, what's the state of ESG investing, and what can we expect, right? So I'll touch upon these 5 things in today's session. I want to just provide a very brief introduction about CFA Institute. So CFA Institute is a global not-for-profit organization. We are the world's largest association of investment professionals, right? So I think CFA Institute is most famous for its exam, but we are also a professional association of the investment professionals, right? We are an industry leader. Our mission is to lead the investment profession globally, and by promoting the highest standards of ethics, education, and professional excellence, right? So we focus on not just education, but also also the ethics as well as professional excellence. So most of our work on standards and research is around professional excellence, and that's what I focus on within the institute. And we have a vast global network of membership, and some of you here are part of that network. And so we do research on many areas, including ESG. So I want to start the discussion by talking about what is ESG investing and what are some of the drivers and influences. So this is one of the most common definitions of ESG investing. It is an approach to managing assets where investors explicitly consider environmental, social, and governance factors in their decision making for the purpose of long-term return of investment portfolio, right? So I think ESG or sustainability works over a long-term horizon, and ESG investing focuses on the long-term return of an investment portfolio. Now, ESG is what it's a subset of what you call non-financial factors, right? I mean, the example that I like to take is, a couple of years back, the noted singer Kylie Jenner, she posted a tweet saying something like, am I the only one using Snap, right? Now, after she posted that tweet, Snapchat, right? The stock fell by 6%, right? Now, it's not exactly a financial, like, the stock prices in that instance was not in, like, reacting to a financial information, right? It was reacting to a tweet, which is a non-financial information, right? So in recent years, the emphasis of non-financial information and the impact of non-financial information on stock prices have gone up, right? And we can see that all around us. We can see that in terms of reputation, in terms of brand, in terms of, the technology and human capital and things like that. So ESG is an important component because ESG represents material non-financial information which impacts company stock prices. Now, I have listed some of these factors in this slide. And as you can see that, these factors are come under, like some of these factors are environmental. Climate change, the first one which you see is probably one of the most important ESG consideration. In fact, like so much so that, climate investing has become a, area in itself, which is almost seen in parallel with ESG investing, right? But other factors also impact share prices in different ways for different industries, right? So with social, you can have like working conditions, employee relations, supply chains would also be considered a social factor. Within governance, some of these things are bribery, executive pay, board diversity, and tax strategy, right? So I think some of the technology companies in recent years in the US have come under pressure because a political class and even other stakeholders have questioned their tax strategy or minimizing their the amount of taxes that they pay, right? So that's broadly what ESG investing is. So what I'm going to do is I'm going to stop here and I'm going to launch a couple of polling questions, right? So just to put some meat into what I'm talking about. So let me see if I can launch the first polling question. So there are two. So there are two questions in this poll. I would like you to answer the best you can, and after a few seconds we can look at the results, right? So let's just spend about 30 seconds before I can close this poll. So the first question is, which of the following issues are most relevant for companies in the fashion industry? The second one is, which of them are most relevant for companies in the retail industry? All right, I can see some answers. Let me just give it a few more seconds. Right. All right, so we have a few responses. I'm going to end poll. All right. So, for the first question, right? So which of the issues are most relevant for companies in the fashion industry? Most of you have, said modern slavery or working conditions. I think, some of the fashion brands, especially fast fashion brands, have been in the news for the wrong reasons, right? In the recent years, that's about working conditions and modern slavery related issues. That's right, right? Pollution is a big issue, right? I live in India, and textiles, the chemical, effluents is a big problem. So that's two. Climate change, it could impact the inputs to some extent, like cotton, So some of the inputs to fashion industry might be impacted by climate change or potentially uh, the pests, right? So the diseases impacting cotton and things like that. So they could be influenced by climate change, right? And deforestation, potentially, not the most popular answer, and trade association, right? So the second question for retail industry, similarly, right? So once again, working conditions, right, makes sense. Waste management, right? So the plastic packaging and those kind of issues could potentially impact waste. I remember McDonald's was in the was in the news for the wrong reasons, in the 1980s and stuff. They had this clamshell packaging for burgers, right? And it used to fill the landfills like anything, right? So among other issues, waste management is a big issue, right? Trade association, lobbying and donations, 36% said yes. Deforestation and climate change, not to the same extent, right? So I think one aspect that comes out, right, clearly is that, what impacts different industries could be different, right, to some extent. So we have a concept called materiality, right? So materiality just means that which are the most material issues for companies in a particular industry or even for a particular geography. And those material issues are what impacts stock prices and what investors care about, right? So for an analyst who are analyzing companies in fashion industry would care about working conditions and modern slavery and its potential impact on reputation, whereas for retail industry he might care about waste management, right? So that's broadly what the issues are. uh, Now moving on, right? So some of the influences, what is driving ESG investing? So I think the beginnings were in 1970s. The first sustainable mutual fund, the Pax World Mutual Fund, can be traced to Vietnam War, right? So post Vietnam War, investors both the retail investors as well as some institutional investors were agitating against some of the how the war was going. So Pax World mutual funds were created by religious investors, and that mutual fund excluded weapons manufacturers, right? So who were supplying weapons for Vietnam War. So that's the beginning of the first sustainable mutual fund, right? Brundtland report, I want to highlight 1987. That's because if you have done civics lessons that I have, like you would remember sustainability definition as the ability to meet the needs of the present without compromising the ability for the future to meet their own needs, right? So I don't remember if you can recognize that definition. So the definition of sustainable development first came from a Brundtland report, which was sponsored by the United Nations, right? So the beginnings were between 1970 and 2005. In phase two, it really started accelerating, right? So UNPRI was launched in 2006. UNPRI is essentially investors who want to adopt responsible investment practices, or like the 6 principles of UNPRI. If the signatories are expected to consider ESG within their investment process, right? So that kind of, as of today, the number of signatories as well as the assets under management are in the trillions, right? Assets under management. I think I have in one of the final slides, it's close to 100 trillion or something like that. They are signatories of UNPRI. Some of the agreements, on COP, a committee of parties, including the Paris Agreement, which was a successor to Kyoto Protocol. So those kind of international agreements also accelerated sustainability and sustainable investing. And so you can think of 2006 to 2019 as developing or accelerating for ESG investments. phase three, post-pandemic, I think you can say that ESG investing have gone mainstream, right? So the COVID-19 pandemic, like some of the issues that we have seen with respect to racial inequality and in general inequalities and so on. And all the standards and development that regulations that we are seeing in different markets, you can say that ESG investing has kind of gone mainstream if it hasn't. And we'll see in terms of some numbers also how mainstream ESG investing is today. So the other influences I want to talk about is companies proactively adopting sustainability practices. Both companies are investors, right? So that they are all the stakeholders are adopting. So some examples are like companies like 3M. Even way back in 1975, the company introduced its pollution prevention PACE and has saved $2.2 billion in savings because of pollution prevention measures, right? FedEx is another example. It aims to convert its entire 35,000 strong fleet by electric or hybrid engines. By November 2019, FedEx converted 20% of its fleet, right, reducing fuel consumption by more than 50 million gallons, as well as reducing its carbon footprint. And like Campbell Global is actually an investment firm which is into timberland. So it has basically focused on natural resource investments with a sustainable lens, right? So it's both companies as well as investment firms that have taken up sustainability in a big way, right? So these are some of the drivers which is driving ESG investing. And among other influencers, right? So this one, I'll talk about both the role of institutional investors and retail investors. I'm just picking a couple of examples. I'm not delving deep into the research. I mean, there are plenty of research which talks about the adoption of ESG investments, right? So, in general, how many, we asked, for example, we had a member survey, over the years. And we asked them, which of the ESG areas do you or your organization take into account in your investment analysis or decisions? So those numbers have going up in a significant way over the years. And the numbers who say that we don't consider ESG investments are falling, right? So I don't, I haven't put the 2022 numbers. I have to check, but the numbers have gone up even further. And lastly, what's the the other question we asked in some of our surveys is why are you why have you taken up ESG investing, or what's the motivation for you or your organization to take ESG issues into considerations, right? So typically the responses range between it helps for managing investment risks. Because we talked about it earlier also, right? So if a fashion company fails to consider the working conditions of its suppliers, it imposes significant reputation risk, right? So ESG considerations are are also a risk management consideration, right? So I think those numbers are significant, are always fairly significant consideration. Sometimes clients and investors demand is a significant consideration. And lastly, for firms, they believe it is in their fiduciary duty. Fiduciary duty simply means that you make an investment taking into account the best interest of the beneficiaries, right? So for example, if you are a mutual fund investor and buying an ESG mutual fund, then what the mutual fund firm is saying is that we need to manage this fund according to ESG consideration to protect our best interest of our investors, right? So for pension funds, it could be beneficiaries, anyone who's investing in for their retirement. Pension funds also have fiduciary duty to consider ESG issues in order to protect the downside, especially, right? So risk management is an important thing for ESG. So across APAC, help managing investment risks is most important consideration. followed by investor demand, and a fiduciary duty also comes up at a significant reason for ESG investing. Yeah, so I have one question in the chat. What are your thoughts on some recent pushback that ESG considerations have been overblown versus their actual impact? So if you can just hold on. So I am taking your exact question in my fourth section, which is on criticisms around ESG investing as well as response. But I would encourage you to keep sending your questions, and at the right time, I'll be happy to answer some of these questions. Moving on. So I think just considering from a retail investor standpoint, right? So we covered some considerations from institutional investors, why they are taken up ESG. This is just a retail investors consideration. So we undertake a biennial survey of retail investors as part of our Earning Investors Trust Study, or we call it just the trust study. So as part of that survey, we ask questions of retail investors about their interest in ESG strategies as well as adoption in ESG strategies, right? So the interest in ESG strategy is consistently high, and the adoption is still growing, right? So it's not, I wouldn't call it low, but it is growing, right? So there is a significant business opportunity for firms to kind of be able to demonstrate. I'm not saying that they should just claim that they are considering ESG, but to be able to demonstrate how they are considering ESG as part of their investment considerations. And lastly, as part of the same survey, we ask this question, right? So which is how much are you willing to give up some return for a values-based objective? Now, I think the link between ESG and performance, right, is mixed, right? So it's I mean, there are studies which say that ESG leads to better investment performance, and there are other studies which say that ESG is kind of correlated with some of the traditional factors like quality and low volatility and things like that. Because of their correlation with traditional factors, it is difficult to kind of disentangle ESG's performance, like ESG and investment performance, right? So the question is assuming there is a trade-off between ESG and investment performance, we ask retail investors, how much are you willing to give up some return, right? The numbers are surprisingly high if you think about it, right? So, I mean, India was a bit of an outlier. I'm sorry, we don't have the results for Philippines in the slide. I will check if there is something in the data set. But among major markets, some of the APAC countries had significantly high number of investors saying that they are willing to give up some return for a values-based objective. So that's the section on just an overview of ESG investing, and what is driving ESG investments in recent years. I will if you have any questions, please use the chat button, and I'll try to answer them as I go along. But I will move on to the next section, which is the approaches to ESG investing. So I'm going to kind of play a video, which talks about 6 approaches for considering ESG factors, or let's call it 6 ESG investing approaches.
Did you know investors use 6 methods for bringing ESG considerations into their decision-making, often in combination with one another? Exclusionary screening is the oldest method for evaluating ESG standards. It's centered around avoiding securities of companies based on activities that conflict with your moral values, products involving alcohol or gambling, for instance. It also applies norms-based screening, meaning reviewing investments based on compliance with relevant international norms and standards, such as those pertaining to human rights. Best-in-class selection, also known as positive selection or positive alignment, is about investing in companies with better or improving ESG performance relative to sector peers. This method can improve the risk and return characteristics of a portfolio, as a strong ESG policy makes companies more aware of their risks and increases transparency. Active ownership is about engaging deeply with companies and entering into a dialogue on ESG issues and exercising ownership rights and sharing your voice to affect change. Examples include meeting with company representatives, filing a shareholder resolution, and engaging in public dialogue with policymakers. It is considered by many to be one of the best methods to maximize returns and reduce risks. Thematic investing is a type of investing based on following social, industrial, and demographic trends. Sustainability is at the heart of many of these trends, like clean tech, green real estate, and sustainable agriculture. The goal of impact investing is simple: to select securities with a disclosed intention to generate and measure social and environmental benefits alongside a financial return. An example of impact investing includes backing businesses that generate jobs in underserved communities. Lastly, we have ESG integration, systematically and explicitly integrating ESG considerations into investment analysis. Are you prepared for the rise of ESG?
All right. So that's it's I thought I could mix it up with a video, but I'm sorry. So just to summarize, right? So there are 6 approaches, when it comes to ESG investing, and these approaches differ in terms of their risk return characteristics, as well as their impact goals, right? So ESG integration. At the top, I have traditional investing with no regard for ESG factors. And the second row, ESG integration, has an explicit consideration of ESG factors in investment decision making, right? Now, for example, if you go back to the example of a fashion industry, right? Now, there are 2 companies in the fashion industry, and if you believe like one retailer, one fashion, fast fashion company, does not do enough supply chain audits, right? So he has a factory in Bangladesh or one of those or Vietnam, and they are not doing enough supply chain audits. And the second one has a much more robust process, right? Now, as an analyst, if you are valuing that particular company, you will adjust the cost of capital correspondingly, right? So for a company which has poor supply chain audits, or which has a higher risk of reputational damage, you might assign a higher cost of capital than one which has better supply chain audits and assurances, right? So that's an example of ESG integration. In a practical perspective, how an analyst integrates ESG in their investment process, right? Now, both 1 and 2, traditional and ESG integration, to some extent focus on superior risk-adjusted returns, right? So I think the end of the day, ESG integration is making sure that you take financially material information into account to better your analysis for into companies or other investments, right? So that's ESG integration. Exclusion or negative screening is slightly easier. I mean, it is excluding certain companies to avoid risk or align with stated values, right? So the example I took at the beginning, right? First mutual fund, Pax World, it was catering to Christian investors, and the context was Vietnam War, and it excludes weapons manufacturers, right? Now, more recently, in the Ukraine war, some companies which had earlier excluded weapons manufacturers had started including them because those manufacturers had started supplying Ukraine, right? So, I mean, we might come back to this come back to my last point under criticism. Like sometimes these things can be fairly subjective, right? The third one, best in class or positive screening, targets companies with a better ESG performance in a segment. That is fairly simple, right? So you just focus on ESG, whether it's the score or whether it's ESG issues that we consider, but you target companies with better ESG performance. Active ownership is, making sure that you exercise your stewardship, right? So, for example, you might these need not even be in the ESG space, right? So you might, buy a particular company and then like push for better gender diversity within that company, right? Or you might buy a company and then push for better working conditions within that company, right? So active ownership is like, making sure that you are exercising voting rights and influencing behavior, right? And the normal case, active ownership could also mean about capital allocation decisions, but within ESG, it is usually about ESG matters. And lastly, thematic investing is about target specific themes. Companies which are into, let's say, sustainable real estate could be a particular theme, right? Companies which are into clean water, clean tech, renewable energy, etc. So these are potentially ESG specific themes and trends. And lastly, impact investing. In the example in the video, they talked about investing with a social orientation, right? So potentially serving underserved customers and things like that, right? So as you go down this list, what you will see is that it moves away from mitigating risk to making more positive impact, right? It moves away from focusing on superior risk-adjusted return to potentially be accepting of baseline expectation of market returns or even below market or market rate returns in the case of impact investing in order to improve the potential impact, right? And philanthropy is the other extreme where you even accept a loss of capital, right? So that's the spectrum of ESG investing approaches. What I'm going to do is I'm just going to launch another polling question just to clarify what we have been talking about. It's just one question. So a portfolio manager removes alcohol and gun manufacturers and selects top 50 companies with the highest ESG rating. She then engages with portfolio companies on their capital allocation decisions. Now, which of these investing approaches are covered in this example? All right, I'm going to give a few more seconds and then I can stop. All right. All right, so 69%, yes, she removes alcohol and gun manufacturers, right? 23% said best-in-class positive screening. So top 50 companies with the highest ESG ratings would be considered best in class or a positive screening approach, right? So that's that's two. ESG integration. Now, I think so there is some uh, investors who would consider like selecting a best in class also as an example of ESG integration. But in our definition, the way we have defined in the video and in this particular exhibit, ESG integration is basically integrating ESG in your investment analysis, right? So I think, it's not like if you only select based on ESG ratings, that would be more under best in class. But if you also kind of consider their fundamental factors, right, along with their ESG ratings and so on, that could be more closer to ESG integration, right? The active ownership, there is a part about, engaging with portfolio companies on capital allocation decision. Now, capital allocation decision, like engagement with capital allocation decision need not be under ESG, right? But it would be considered active ownership, right? So it does not need to be like, so you can have traditional investment approaches, which includes active ownership, like hedge funds, right? So they take a big stake, they push for capital allocation, changing, like, paying in dividend and things like that. So active ownership is clearly part of the investment approach, right? So although it's not exactly related to ESG, and it's, I mean, I wouldn't consider it's a thematic example of thematic investing, right? Now, one thing which I want to highlight in this example is that in one investment strategy, you can have more than one investment approach, right? You can have exclusionary screening and positive screening and active ownership and maybe even ESG integration, right? So in this example, if she had like, possibly considered like, after taking top 50 companies by ESG rating, and like, if she had then like, looked at their price to earnings or some other fundamental factors that could be closer to ESG integration too. So you can have multiple approaches within the same investment strategy. And that's what I want to highlight in this example. All right. If you have any questions, like, feel free to use the chat button, and we'll tackle it. Sorry, 1 second. So that's covers the second section, which is investment approaches. So you know what ESG investing is, and you know how ESG investing happens, right? So there are actually 6 approaches. The third one we are going to talk about is ESG investing landscape, right? So how, like, in terms of assets under management, how does ESG investing landscape look like, right? Now, so there are studies, surveys. So like, the most popular among the like, the like associations and collectives which track global sustainability assets is what we call Global Sustainability Investment Alliance, or GSIA. So GSIA is a bit of a misnomer. It's not global. It only covers developed markets, right? So it covers North America, Europe, Japan, and Australasia, right? But these markets account for like, pretty much like a very large portion of investment assets as well as sustainability assets. So, we can make some sense of where the ESG investments are going by just looking at these very large markets, right? So the total AUM of these regions, right? So like, this is a biennial report. So they take quite a bit of time to actually process the information through their members. So the 2020 data was available as of 2021. So the 2022 data is still awaited, right? So we don't like, it'll take some time. We have to probably wait till next year to actually look at 2022 data. So the total assets under management of regions, right? So these include both the both the public mandates as well as investment mandates, which are part of separately managed account or portfolio management service or whatever we call it, right? They collect all kinds of information from information that is available from annual reports and other sources. So the total AUM of regions in 2020 was close to $100 trillion. So I'm sorry, I didn't put the units, and it's my fault. So 98 trillion, right? So 98 trillion is the total AUM of regions, and the sustainable investments was about 35 trillion, or 35% of all investments was had a sustainability consideration, right? So that's a fairly large proportion of assets, right? Now, the approaches could be different. So even if a mandate simply excludes tobacco or alcohol, so that will be considered as sustainability investments. So it doesn't say anything about what was the approach. It only says that out of close to 100 trillion of assets across those developed market regions, 35% or 36% was in sustainable investments, which is a very large percentage, right? I have one question on the chat which I want to answer before we proceed. Is my observation correct? The deeper you engage in ESG activities, the lesser the financial returns. Okay. No, actually, that's not, I wouldn't call it that. So what I would call is the intentionality of financial performance, right? So if let me just go back to the table that you're referring to. The question is, as if you go down, does it mean that you're going to get less returns, right? What I'm saying is it's not like the realized returns, but the intentionality, right, of returns. So when you have philanthropy, then you have zero expectation of returns, right? So you're just giving your money away. In impact investing, what you're prepared to do is potentially accept below market returns in order to make a positive impact, right? Whereas in other things, your intentionality is that you will expect, if you are only using best in class or positive screening, your expectation will still be market returns, right? Now, your realized performance could be better market returns, right? For example, if you exclude coal in your investment portfolio, right? Now, if climate change becomes a big consideration, and therefore, most of the coal needs to be below ground, I'm not saying that's what is happening everywhere, right? But if it so happens that because of climate change, most of the coal needs to be below ground, and therefore the companies which are engaging in production of coal will suffer in terms of performance, you might end up getting an above market return, right? What I'm saying is the goals or the intention of this investment is at least maintain market returns as part of the strategy. I hope that answers. Going back to the sustainability assets, right? So I mean, it is not surprising that US has a significant portion of sustainability assets, only because US also has very high portion of overall assets, right? So in terms of overall assets, also US US market cap is what, close to 50% of global market cap. So or 55% of developed markets market cap. So you'd imagine that even though in terms of percentage US comes first, in terms of proportions, you would imagine Europe comes pretty high, right? So Europe, in terms of assets, is is a bit lower than US, but it still has 34% of sustainability assets, right? So US and Europe are the top two. Canada, Japan accounts for 8%, Canada 7%, and Australasia about 3% of sustainability assets. This chart shows with respect to ESG investing approaches, right? Now, if you see the table, it actually has 7 rows, not 6. We only talked about 6 methods. That's because GSIA, splits the splits the negative or exclusionary screening with norms-based screening, right? So they just they don't call it exclusionary. They kind of distinguish that as negative screening as well as norms-based screening. So this like if you recall the video, exclusionary screening is based on anything, religious exclusions or other kinds of exclusion. Norms-based screening is basically based on norms such as UN Global Compact or UN Principles of Human Rights, right? So there are how companies are adhering or not adhering to some of the global norms such as UN Global Compact is what drives norms-based screening, right? So the row 2 and 4 in this table, it's actually both relates to exclusionary screening in our 6 approaches, right? Now, even with that background, right, what you can see is that ESG integration is by far the biggest, in terms of assets under management, in terms of approaches, right? Now, I want to remind you that these numbers are not exclusive, right? So if you recall the polling question, one strategy can have multiple approaches. Therefore, like if you add up these numbers, you're not going to get 35 trillion, you're going to get more than 35 trillion, right? So you can see that for yourself for 2020 row, right? But, most of the investment mandates have an ESG integration approach. That's what you should take out of this exhibit, right? And negative or exclusionary screening comes at second. And if you exclude norms-based screening, put together, it accounts for 19 trillion compared to 25 trillion for ESG integration. I hope you are able to follow my numbers. If you also see the row, if you see the last column, I have a CAGR number, calculated between 2016 and 2020. What you see is, between 2016 and 2020, ESG integration approach grew in terms of assets, right? Whereas negative or exclusionary screening was largely flat, right? And norms-based screening, in fact, fell by 10%, right? So ESG integration is has become the most popular approach, whereas only 6 years back, negative or exclusionary screening was a popular investment approach. The next one, I try to put both together, right? So which of the approaches are most popular in which of the regions, right? Now, Europe, interestingly, screening-based approaches are the most popular, right? So what I do is norms-based screening, a negative exclusionary screening. If you recall the previous slide, that's about $19 trillion in total, right? So if you see this column, 15 trillion for negative and 4 trillion for norms-based, right? So out of those 19 trillion, you will have about 70% coming from Europe, right? So Europe, norms-based or exclusionary screening is very popular, whereas in US, ESG integration and impact investing are the most popular strategies, right? Japan, which is on the last column, last but one column, active ownership is a very popular strategy, right? So Japan's pension fund, GPIF, General Pension and Investments Fund, so it's one of the largest asset owners, and they use an active ownership-based approach. So they invest in companies and they engage with them and they use stewardship, they engage with the companies to kind of bring about better outcomes on ESG considerations. So in Japan, active ownership is a very popular investment approach. Okay, there is a question on the chat. Why ESG integration is the most popular approach, right? So if you think about exclusionary screening, it is very basic, right? So all you do in exclusionary screening is that you say that, look, I mean, my only interest in ESG is to exclude alcohol company or tobacco companies or coal companies, right? So it doesn't take a lot to actually adopt an exclusionary screening approach, right? But what investors are finding out is that merely excluding investments is by itself not going to bring about a significant influence on risk and return considerations, right? So ESG integration, on the other hand, it's a much more holistic approach compared to exclusionary screening when it comes to considering ESG factors, right? So going back to that retail example, right? So or fashion industry example, right? So what you want is to make sure that ESG is part of your investment analysis. It's not some filter that you impose at the beginning and say that now I have considered my ESG in my portfolio, right? So ESG integration is to some extent a better approach when it comes or more holistic approach compared to simply screening. And that's possibly one of the reasons the popularity for ESG integration has increased, right? So that's what I think. Let's go to the next slide. So let me see if I can launch a poll just to keep it, break the monotony. 1 second. I'm going to launch this one question. Which of the following statements are true? Oh, I'm so sorry. I don't know if I can see the whole. Yeah, you can see it if you increase the window. With the share of exclusionary and norms-based screening have fallen in recent years, actually, because because we asked that question, that should be easy enough. Active ownership is the most popular strategy, and ESG integration is the most popular ESG strategy in Europe. So there could be multiple right answers. So select all that apply. All right, a few more seconds. All right, going to hit the poll. Yeah, so both choice 1 and 2 are correct, right? So exclusionary strategy, share of exclusionary or norms-based screening strategy in ESG investing has fallen. So we saw that, right? So I think exclusionary exclusionary screening, it was either flat or it was falling. So the share of exclusionary screening in the overall ESG investing, that also has fallen, right? Because other strategies has risen in terms of assets, whereas the exclusionaries either remain flat or it has fallen. So the share has fallen. And the second one, active ownership, is the most popular strategy. So ESG integration is not the most popular ESG strategy in Europe. It is exclusionary screens, which is more popular than ESG integration. So I think this section is, typically the most interesting section, because I also saw one comment in the chat, about what was that? Pushback on ESG consideration. Are these overblown versus their actual impact, right? So let's just quickly look at the criticisms, right? So one thing is potentially let's call it communication gap. I know people have sometimes called it greenwashing, but we think that a lot of these greenwashing is unintentional communication gap, right? There could be some investment firms which could be deliberately misleading. I know that recently, even the German police raided one of the investment firms on greenwashing allegations and stuff. There could be some like something fishy going on in some places, but broadly speaking, we believe greenwashing is essentially a communication challenge because for investors, how are ESG issues considered in this product objectives and in the stewardship activities? They want to understand that. And investment managers would like to explain various ESG approaches that we have incorporated into our products. We already know that there are 6 approaches and stuff, right? Now, the problem comes with respect to terminology, right? When people say ESG integration, when investment managers say ESG integration, if investors don't understand what ESG integration means, there could be a communication gap there, right? The assumptions which are used by investment manager, right? So for example, if the investment manager is simply removing, let's say, let's say if an investment manager is including oil and gas companies, right? But he adopts an active ownership approach, right? So he meets with the oil and gas companies and he says, tries to influence them to kind of improve their, carbon emission disclosures and things like that, right? He will still have oil and gas in his portfolio, right? But if he does not communicate his assumptions behind those investments or what his approach is going to be, the investors are going to just see oil and gas companies in the portfolio and going to believe that, the fund is not ESG aligned or, ESG considerations are not there in the fund, although it's claimed to be ESG, right? And then the last one is, of course, there is quite possible that investment manager could deliberately mislead is, how much ESG they are considering in their investment products, or they could simply remarket some of their products. I think in the German case, the issue was that because ESG became popular, the fund basically repurposed their normal funds, and they claimed that these are actually ESG focused funds, right? So there could be something which is misleading, and there is an issue that like both the industry as well as the regulators need to sort out, right? But most of the time, the issue is basically a communication gap, right? You're not communicating what you're doing, and therefore investors don't know what they are doing, and therefore they are going to say that you're not. It's just greenwashing, right? Or it's just misleading communication. So one approach for tackling this is standards, right? Now there are range of standards across the value chain, right? What we talked about, right? End investors like you and me investing in ESG funds and the communication gap that comes within. It's also possible between fund managers and companies, right? Now, the fund managers might want to invest in companies which consider ESG issues, but the companies may not be doing a good job of how they are communicating their approach to ESG issues, right? So the same problem might arise between companies and fund managers. And there could be greenwashing, there could be deliberate greenwashing by companies too, right? And fund managers might be investing thinking that these companies are considering ESG, but the company might just be misleading in their reporting and so on, right? So what reporting standards do is they try to reduce the communication gap, right? So between corporations and investment managers, you have sustainability reporting, which is what SASB, SASB, GRI, CDP, TCFD, and everyone tries to do. Whereas between investment managers and end investors, there could be investment product related communication, right? And that's where, for example, CFA Institute has its own standards for investment products, which basically says that if investment manager is adopting, let's say, one of the 6 approaches, right? So the exclusionary screening or active ownership or whatever it is, right? If he's using a particular investment approach, then he should disclose certain things to investors, right? So that's how you reduce that sort of communication gap, and that's how you put everyone in the same pedestal, right? So I think when I say end investors, it could be advisors also, advisors advising end investors on, let's say, ESG mutual funds. Even they need to look at those same communications and make sense of what kind of ESG products they want to recommend to their end investors, right? So when I say end investors, it could mean retail advisors as well. So that's what it is, right? So in this case, like I said, so we have a global ESG disclosure standards for investment products, and and that's how we try to kind of reduce that gap between how investment managers explain their approaches and how ESG investors consider products in terms of objectives and process and stewardship. And we have things like we kind of have what kind of information needs to be disclosed as part of your mutual, like in the case of mutual fund, you have something like scheme information document or key information memorandum, or whatever the terminology which you use in in your market, like what kind of disclosures needs to go in those documents is what is covered in this standard. The other criticism, right? So I think there are a few, and I'm happy to kind of here take some questions, right? Now the thing is, ESG is subjective, right? So there is like one thing about materiality, right? Now, what is considered material depends not just on the company as well as the industry. It also depends on the investor, right? So two investors investing in a particular fund might consider different issues, right? So the first investor who's who's interested with climate change would want to would want to avoid fossil fuel companies altogether. The second investors might say that I want to invest in companies in funds which take an active ownership approach to fossil fuels, right? So even materiality for investors could be different. For companies, it obviously could be different, right? So I'll just post my last polling question and talk about this in a bit. There could be competing objectives. There could be I mean, during the Ukraine war, there were flip-flops, right? So, or I mean, it's an extreme form of competing objectives. So you have like the example I took earlier, right? So you had funds which excluded weapons manufacturers and then started including them because those weapons manufacturers were arming Ukraine armed forces, right, against Russia. So as European investors, they switched their allegiance towards weapons manufacturers. They thought that weapons manufacturers are great for freedom, right? It may be bad for lives, but it's great for freedom, right? So I think things like that makes it people question as to what exactly is ESG investing and what these objectives are, right? So I think so at the end of the day, the only thing we can say for sure, right? ESG is subjective, right? Doesn't mean that it is not useful, right? I mean, a lot of the some of the most interesting things in the world are subjective, right? So non-financial information, contextual information, they're all subjective, right? So I think it's it is a reality that ESG is subjective. You can't wish it away. So sometimes coming back to the second one, ratings confusion, right? So there is poor correlations among rating agencies. People kind of ESG rating providers give letter ratings like AAA, BB, and so on. And people think that because these look like credit ratings, therefore these ratings actually mean something, right? But then they look at the ratings correlation, like if let's say MSCI or Sustainalytics or Bloomberg or any number of providers provide these ratings, they see what's the correlation between the ratings across providers, right? And they find that the correlation in some of the studies were as low as 0.3, whereas for credit ratings, the correlations are usually close to 95% or higher, right? So if S&P says it's AAA, Moody and Fitch will also say it's AAA, right? So whereas if S&P, if one of the ESG rating providers say it's AAA, then it is very likely that the other one will say triple B or something like that, right? So poor correlation. So where does this poor correlation come from? ESG, well, the fact that ESG is subjective, right? So once again, right, does it mean that ESG ratings are not useful? No, I think what it means that investors need to understand what these ESG ratings represent and figure out if those methodologies align with their beliefs or investment considerations, right? So I think the point is not to kind of throw away, right? So it has these things have information, but if you blindly just take, if you want a high ESG portfolio, let me just buy this ESG ratings and let me just put some filter and rank it and so that's that kind of a blind approach to ESG consideration. It's not going to work, right? The other thing is there is a usual confusion between ESG ratings and impact ratings. So something like, okay, so if there is a beverage company, right, which uses a lot of water, right? Now, let's say if the beverage company has a factory which is there, which is present in an area which has a lot of water, right? It means that its ESG ratings is potentially low. I mean, I'm sorry, the ESG ratings is potentially high because why? The water risk for that beverage company is low, right? Because it has access to plentiful water. But what about impact ratings? The beverage company still draws a significant amount of groundwater for its operations. So its impact on the community could still be high, right? Because it draws a lot of water. If it doesn't take actions to replenish that groundwater, the impact rating could still be negative, right? Whereas the former ESG ratings, which only looks at the risk to the beverage company's business, might say the risks are low, right? So there is two kinds of ratings, and there is some rating confusion among investors as to what each rating means, right? And lastly, the role of finance, right? So policy with regulations versus climate and sustainability goals. So I think people ask that, should finance solve planetary problems, right? So which is what I mean, climate investing, ESG investing, sometimes, you can overstate the case for finance, and you can so politicians kind of go along with it. So, because if you have to go tackle a problem like climate change, right, it needs government spending, right? It needs R&D from government. It probably needs some carbon prices, right? So which probably means that it's going to be expensive for voters like you and I, right? So those are difficult choices, right? So it is easier for policymakers to simply say finance should lead should solve the societal challenges instead of looking at policy and regulation. So that's a criticism which is frequently leveled when it comes to ESG investing as well. So, and that is, I would imagine it's a pretty valid criticism. It can't be finance alone cannot solve these challenges, but it has a role to play. It alone cannot solve those challenges, right? So I'm going to actually post my last polling question. Maybe we'll have a few minutes to take a few questions, right? So just bear with me. I see a few messages coming through, and I'm going to post my last polling question first. All right. I think there is no right or wrong answer. It depends on your opinion. But this is the question, right? Which of these three would best represent a trade-off, the application of ESG criteria? One retailer invests in R&D for biodegradable packaging, while other does not because such R&D is expensive. Would you call this a trade-off? Second thing, a high-end retailer offers cage-free chickens, while another retailer caters to low-income customers and does not offer cage-free chickens because cage-free chickens are expensive. I don't know if you can actually see the whole line. I hope you can. let me know if you can't. The third one is an asset manager affiliated with a religious institution removes companies involving stem cell research, right? Would you call that a trade-off? Just a few seconds and then we'll close. All right. I will end this poll and share the results. All right. So 56% of you said like one retailer invests in R&D while other does not, since such R&D is expensive. I suppose there is a trade-off here, doesn't it? It's a like, I mean, it is sustainability investments, can be expensive, right? The question is, what is the like payoff, right? So let's say if you are in a, like, let's say in a company with poor, like if you're in a country with poor regulations, right? Now you might say that, look, this R&D is quite expensive. I can actually give away plastic, like like plastic bags, right? And it can fill the landfill because the enforcement is very poor, right? So the government doesn't force me to kind of provide biodegradable bags, or it doesn't force me to charge customers for plastic packaging and things like that, right? But the risk is that it is always possible that when the tide turns, right? So when the regulations turn, and if there is like an increased regulatory risk that such measures will come into picture, companies which are investing in those sustainability initiatives, they are better placed than those which are not, right? So but there is sustainability is not entirely free. I mean, you still have to this thing at the end of the day, you need to make some decisions about are you willing to invest for the long term, right? In the long term, I would imagine that almost all countries are moving towards potentially polluting the planet less, or managing their waste better, right? The second one is interesting. I personally, I think this offers the best case of trade-off. A high-end retailer can offer cage-free chickens, but if a retailer is catering to a low-income customers, right, like maybe he will choose not to, right? Because the two issues in this are animal safety, which is a major issue when it comes to social issues, right? Versus affordable nutrition, right? So I mean, we spoke about some of the issues at the beginning, ESG issues at the beginning of this presentation, but the two issues can be in conflict, right? So do you maximize animal safety and animal rights, or do you maximize affordable nutrition, right? Maybe one retailer can and other cannot, and both are legitimate goals, right? And it's a trade-off, right? So you, at the end of the day, you need to figure out who your customers are, what you're catering to, and which are the issues. So that's also why even among an industry like retailers, the issues could be different, right? What constitutes materiality could be different. So a high-end retailer, high-end customers, right? They might care about cage-free chickens, but if you are living hand to mouth, you just care about nutrition, right? The last one, I wouldn't probably think of it as personally, I wouldn't think of it as a trade-off. It is it's a choice, right? So it is catering to companies. I mean, you would imagine stem cell. I suppose it's a trade-off to the extent that stem cell research is probably a public good, but the asset manager might choose not to introduce companies which are involved because of its customers, right? So that's broadly today's presentation. I'm sorry, kind of overran a bit, but I'm happy to take any questions. I see a few in the messages. Let me just take a look. We can provide, I'm happy to share the copy of the deck, after this session. And do you find a specific sector or geography which has especially poor correlation among providers? I don't know, quite frankly. I know a few examples. So, for example, um, Tesla is a popular case where I know that one provider gave it a high ESG rating because it is in renewable, electric vehicles, which is great when it comes to E dimension. Whereas another provider gave it a average or a poor rating because Tesla's governance was considered very poor, right? So I mean, the personality and the cult of Elon Musk. Some of those governance issues was the reason why a second rating provider gave it a poor rating, right? So that's the thing. I don't recall if there is a sector or a geography specific phenomenon. I'd be happy to take any other questions. I don't know if you can unmute yourself or but I'm happy to take any other questions. All right, we'll give it a minute.
Yes, let's wait for
Yeah.
a minute or two.
Sure.
If you have questions for Sabi, please send it through chat, or yeah, you can unmute and give your question directly.
Yeah.
So we have here another question.
All right. Yeah. I think so some of the issues impacts all countries, right? So climate change impacts all countries, whether it's developed or it impacts developing countries more because they lack the resources to kind of adapt themselves from the ravages of climate change, right? So if anything, climate change impacts developing countries more. Therefore, you would imagine, and I think we are also seeing that both at the policy side and both from the investment side, there is pressure to kind of move towards better environmentally focused investments compared to less. So that's there. But that said, even within that, like there are development issues, right? So I think I mean, one of the things it is probably easy for developed markets to kind of wean themselves away from coal. But as we are seeing, even during the Ukraine war, it's not that easy to wean yourself from fossil fuels, right? For developing countries, it is even more challenging because at the end of the day, the fossil fuel intensity and GDP growth are fairly correlated, right? So, I mean, growth till date, right, even today, is fossil fuel driven, right? So, I mean, one of the examples I like to take is, electricity. I think people talk about solar energy and renewable energy and all that stuff, right? At the end of the day, electricity production accounts for only 1/5 of the total carbon emissions, right? The other sources are agriculture, construction, transportation, so and myriads of other things, right? So agriculture is entirely fossil fuel dependent, right? There is absolutely, I mean, I've written a piece on sustainable agriculture in India last year, and I can tell you, I mean, it is very difficult in today's world to feed a population of, I think it's close to 8 billion now, 8 billion and growing, without actually using fossil fuel intensive farming, right? So I think, like, at the end of the day, there are going to be development challenges that impact how ESG investments are, perceived, and how much we can actually move away from some of the traditional investments and so on, right? But that said, I think social aspects, I think it's similar, and the governance aspects is universal, right? So bad governance leads to bad outcomes all through, whether it's whether it's companies or even economies. So that's how I think about it.
Thank you. Thank you, Siva, for that for the answer and for the detailed discussion on ESG investing today. Really appreciate it.
All right. All right. I once again want to thank you, the participants, CFA Society Philippines, for the opportunity to kind of present and share my thoughts on ESG investing. Like I said, I think CFA CFA Institute does work on research. We publish standards, and we also offer courses, right? We have a credential on ESG investing for anyone who's interested in it. Thank you so much.
Thank you. Thank you for joining us today and sharing your knowledge on this field.
All right.
To our participants, please turn your attention to the screen for the QR code for online evaluation. Please take time to answer the survey. It will take you about 1 to 2 minutes to complete. So just take a screenshot of the QR code or go to the QR code. So, but last but not the least for today, let us turn on our videos for a photo opportunity with our guest speaker. Any more videos? Okay. Precious, you'll take the photo.
Okay.
Okay.
Okay. 1, 2, 3. One more. 1, 2, 3. Thank you.
Thank you.
So thank you again, everyone, for joining today's info session.
All right.
Again, Ziva. Again, the CFA Society Philippines would like to thank our sponsors, our platinum sponsor, Sea Oil, Philippines Inc., silver sponsors, Video Capital, Coco Life Asset Management Company Inc., and FTI Consulting Philippines Inc. Our bronze sponsors, AP Securities Incorporated, DBP, Daiwa Capital Markets Philippines Inc., and Papa Securities Corporation. Our event partners, FMA, MART, and Sharefill. This concludes our webinar today. Accept our sincerest appreciation for your time and effort in participating in today's activity. Have a good evening, everyone.
Thank you.